Hello, let's discuss the truth of monthly withdrawals or pensions from some of the mutual fund schemes. In that, let's take the example of HDFC Balanced Advantage Fund. Uh, we have seen that many people in the market is selling this fund with the USP of getting 1000 per 1 lakh, or if somebody has invested 10 lakhs they would get 12,000 per month. So it's kind of pension scheme. They have um, devised it as a pension scheme especially for senior citizens and also in generally to the public, because in other schemes of post office or let's say a FD, fixed deposit, people might be getting 600 or maybe 550 per 1 lakh. So it looks very attractive when people tell you that you will get 1000 per 1 lakh if you invest in this scheme, but they do not tell you the risk associated with it. So let's find out the truth. First, let's see what is this HDFC Balanced Advantage Fund. So it is a benchmark for this fund is Nifty 50 Hybrid Composite Debt 65 to 35 Index. So basically, this fund, what it does is mostly it invests in shares or equities in the stock market, and rest of it around 30-35% they invest in debt, which means they lend to big corporate houses or maybe to the government bonds also. They invest in government bonds. From there, they will get interest and also the capital gain or loss from the fluctuation in the prices of bond in the bond market. Keeping that aside, let's see the mathematics, how actually it has given returns. So first let us find out, if we withdraw 1000 on 1 lakh, what is the rate of withdrawal? It's not 12%, like 1000, 1000, 12,000. So it will be 12%. No, that is not. Let's find out. Okay, let's say in 2008, it is simply a date I have given to give you an example. So you have put in 1 lakh and you are withdrawing every month after that 1000 each on first of every month. So at the end of the period, your 1 lakh is intact. So this is minus, this is plus, this is offsetting one another. So the withdrawal rate actually is 12.65, because you are not withdrawing the 12,000 at the end of the year. You are withdrawing it from beginning on beginning of second month, then third month you have withdrawn 1,000. So that way is the withdrawal rate is 12.65. So it is not 12%. Now check the FD rates. They are 6 to 7%, and after taxes it will be even lower. So the returns are in this, if you are getting 1000 and your capital is still intact, that means you are getting at least 12.65%. So that is a huge return in current market scenario. Now let's see the rolling return. What is it? So I have taken two funds, although this fund is a bit different from this fund, the ICICI Prudential Balanced Advantage Fund, but they are in the same category. So I've just, to give you an example, I've taken these two funds. So why this rolling return? Rolling return means that one is investing 1/1/2008. So if the time period is 3 years, so every 3 years, possible 3 years will take. For example, 1/1/2008, 3 years ending will be 31st December 2010. So whole year of 2008, 2009, and 2010, the last date. So that will be one 3 year period. Then the second, if we take 2nd Jan 2008, then the 3-year period will end on 1st January 2011. So that was all the possible 3-year periods we have taken into account. So let's see what is the return. Average is 12%, 13%. That's pretty good. If someone tells you that see average returns are 12% and 13%, so obviously you will get that 1000 per 1 lakh. Now let's see the maximum and minimum. See, if you are very lucky, you can get up to 36%. And if you are unlucky, you might get a negative 4.32%. So in 3 years, there is wild fluctuation in returns. Some person may get investing in the same fund 36%, while the other, if he has invested in a different time period, he might get negative returns out of it after 3 years. Now let's move on to the most important part of it. In the previous slide, I have told you that it is 12.65% is the withdrawal rate. So that means to give you a positive return, so the returns has to be greater than 12%, 12.65, so that your capital is intact. Now let's see how many times this return has been achieved. So up to 12% return consistency percentage of times. That means if there were 100 people investing at different periods of time, then 13% of them got 0 to 8% returns between 0 to 8. And if that person, those 100 people got 25% of the times 8 to 12% return, so still it is less than our benchmark return of 12.65. Now let's add all these, see how many times they might have lost on their capital. Less than 0% is also 4.71, so let's add that also. Okay, so it is 44.32 percentage of the times. So it is like a coin, tossing of coin. You might either lose capital or gain something more than the capital amount. So 44% of the times you lose your capital, not the entire capital, but you will be at a loss. Then let's do this for this fund as well. So this is 47% of the times. It is almost close to 50%. That means half of the times it has given returns below 12%. Right? So the luckiest was here in this time frame. The maximum returns were attained. Someone had invested here, maybe he got the returns. If someone had invested here, he would have got below 10%. That means if he has withdrawn 12 point at the rate of 12.65, his capital will ultimately suffer. So let's look practically with an example, not example, with the past data, what would have happened if they had got the returns lower than estimated. Okay, this is the HDFC Balanced Advantage Fund. Okay, so I have taken the 2008 January as the investment date. So one person has invested 1 lakh. So the total value is 1 lakh. The NAV or the price of the fund is 82.079. Now due to some market correction and the stock markets went down, the price of that scheme also went down to 70 in the next month, 70.79. See what happened. You got 1000 in your bank, but see the value of your fund is 85,248 only. That means it has decreased by 15,000 due to correction in the stock market. So this goes on. 82, then it hits a low of around 35 when March of 2009, and your value has second, your value has decreased to 33,668. Okay, at that point. Now we see an improvement in the price of that scheme. So ideally, our this also has increased value, total value of the fund. Although you are getting 1,000 every month, that is being withdrawn. It has come to 67, almost doubled. Your fund value is 55,000. So hopefully it should increase if it keeps on increasing, right? Let's see what happens. So it has come in 2011, at the end of 2011, it has come to 82, the original price. But see what happened. Your total value is 42,245 because this is like negative rate of withdrawal, because you are withdrawing on one end and the market has gone down and again gone up. So this is the irony of this scheme. If you keep on withdrawing, what happens? If you had not withdrawn, the capital would have been 1 lakh because it is 82.91. So even more than 1 lakh. So that is 2011. Let's see. The fund value has increased. I mean the price of the scheme. So it has come to 90 in end of 2013. But see, your value has gone to 19,840 since you are withdrawing also. So your units are depleting. From where this 1,000 will come if the market is decreasing? Obviously from your capital. So it is compounding negatively, and your value has come to 19,840. Now let's see, by January 2016, the price of the scheme has increased. It has recovered ground. It's 129. Original was 82 when we invested. But see what happened to your capital, 1,412, because you have been withdrawing 1,000 every month. At the end of February, beginning of February, once you have withdrawn that 1,000, your capital is only 305. So after that you cannot withdraw. So you see you have withdrawn 97,000. How many years? 8 years almost. So 8 years you have withdrawn 97,000 of your own capital, and the capital that you have in hand, that is in market, is only 305. Even though the fund has recovered and given you a very good return in terms of price, 82 to 119. So it has given returns. You cannot say that the fund has not done well, but because you have withdrawn at a rate, very high rate, so ultimately your capital has eroded. So the truth is that you should first consult your financial advisor, and if at least the basic idea should be that it cannot be twice the rate of a postal MS scheme or FD monthly return scheme, monthly interest payable scheme. So this is a very important point where most of the people are like missold this product. Although this product is not bad, you have seen that it has recovered, and in 2019 this NAV has increased further. If you had kept the 1 lakh there itself, then you would have gained something. But that is not the way to play this market and this kind of products. So basically you have to thoroughly plan your finances. You cannot just do a just one investment and think that, oh, you have done good investment, and because you got this kind of return, and the fund is bad. The fund is not bad, but the way you have done it is a wrong way of doing it. So thanks for watching this video, and keep watching to learn more. Thank you.